Have you ever wondered what your financial future might look like? We all have. It's a question that keeps many of us awake at night, pondering over the possibilities that could unfold. And that's where investing comes in. Far from being a game for the rich, investing is a tool that can help anyone build a brighter financial future. Imagine a world where your money works for you, where every dollar you save becomes a seed that grows into a strong, sturdy tree. That's the power of investing. It's about making your money work for you, multiplying itself over time. But here's the thing. Investing isn't a one-size-fits-all kind of deal. It requires careful thought, strategy, and an understanding of the risks involved. Some people might find the thrill of buying individual stocks appealing, while others might find the safety and stability of exchange-traded funds or ETFs more suitable. But the question is, should you put your hard-earned money into individual stocks or ETFs? Scene script. First, you need to understand the difference between investing in stocks and ETFs. Imagine for a moment that you're in a lavish grocery store. Stocks are like buying a single type of fruit, let's say apples. You're betting all your money on those apples, hoping the price will go up. If people start loving apples more and more, your investment could pay off handsomely. But what if there's a sudden apple blight, or people just decide they're more into oranges? Your investment might plummet. That's the risk you take when you invest in individual stocks. The potential for high rewards comes with considerable risk. If the company whose stock you've purchased performs well, your investment could grow exponentially. However, if that company faces a downturn, your investment could take a substantial hit. Now, ETFs, or exchange-traded funds, are like buying a fruit basket. Instead of betting everything on apples, you're spreading your risk across apples, oranges, bananas, and maybe even some exotic fruits like dragon fruit and kiwi. ETFs are a type of investment fund and exchange-traded product, traded on stock exchanges. ETFs hold assets such as stocks, commodities, or bonds, and their share price fluctuates throughout the trading day, just like stocks. But here's the key difference. An ETF represents a basket of different stocks, usually tracking a specific index, like the S&P 500 or the NASDAQ 100. By investing in an ETF, you're not putting all your eggs in one basket, or, in our metaphor, not betting everything on apples. This diversification can significantly reduce your risk. If one company in the ETF performs poorly, it's unlikely to drastically affect your overall investment because the risk is spread across multiple companies. However, because you're spreading your investment across multiple stocks, the potential for high returns is usually less with ETFs than with individual stocks. That's the trade-off. Now that you understand the basic differences between stocks and ETFs, let's delve deeper into why ETFs might be a better choice for you. Scene script. ETFs, or exchange-traded funds, are a type of investment fund and exchange-traded product. But what does that mean? Let's break it down. Imagine a basket. Instead of fruits or groceries, this basket contains a variety of stocks, bonds, or other assets. When you invest in an ETF, you're essentially buying a share of this basket, giving you a slice of everything inside. Now, why are ETFs considered safer than individual stocks? Well, it's a matter of diversification. If you put all your eggs in one basket or all your money in one stock, and that stock tanks, you're in trouble. But with ETFs, your investment is spread out over many stocks. If one stock in the ETF performs poorly, it's offset by the others that are doing well. Examples of popular ETFs include the S&P 500 and NASDAQ 100, which track the performance of the top 500 and 100 companies in the US, respectively. You might be thinking, sounds great, but what's the catch? You might be surprised to learn that there aren't many downsides to investing in ETFs. So let's dive into the benefits, shall we? Firstly, ETFs provide diversification. Instead of putting all your eggs in one basket, you're spreading your investments across a range of different stocks. This way, if one company doesn't perform well, you won't lose all your money. You're essentially investing in a little bit of everything in the market, which can provide a safety net. Secondly, ETFs typically have lower risk than individual stocks. Because they're diversified, they tend not to fluctuate as much in value. This can make them a more stable investment choice, especially for those who are new to the world of investing or those who prefer a more conservative approach. Now let's talk about flexibility. With ETFs, you can buy and sell shares just like individual stocks, and you can do so anytime during trading hours. This means you have the freedom to act on market trends as they happen, rather than waiting for the end of the trading day. One potential downside to consider is that ETFs typically don't provide as high returns as individual stocks. But remember, with higher potential returns comes higher risk. It's all about balance and what you're comfortable with in terms of risk versus reward. Another point to keep in mind is that while ETFs do offer a level of built-in diversification, they're not immune to market downturns. If the entire market takes a hit, your ETFs will likely decline in value too. However, they are likely to recover along with the market over time. So in conclusion, ETFs offer diversification, lower risk, and flexibility. They're a great way to get started in investing or to add some stability to your existing portfolio. And while they may not offer the highest potential returns, they do provide a level of protection against the volatility of the stock market. So are you ready to take control of your financial future and start investing in ETFs?